Good afternoon and welcome to our second webinar on lending. And things have changed since the last one, so I'm looking forward to finding out what's available for people who are in the middle of a 1031 exchange and are looking for financing, or maybe you're finding some great deals and want to be able to close on them, what's available for you. This is Shawn's going to tell us who's surviving this, which banks are surviving and which ones maybe won't. So we're just happy to have you here. Shawn Huss, thank you so much for being here. You've worked with
Thank you for having me. Looking forward to it.
Yeah, you've worked with so many of our members, including me, and you're so organized. I love your system of uploading files into your system, and it kind of tells you what's needed. It seems like most lenders should have it organized like that instead of sending it, Anyway, I love your systems. Glad you could be here to share what's going on in this interesting world. So again, welcome. Let's go to the next slide. And I don't know if we've got okay, yeah, our next, our webinar tomorrow will be on Tampa. We had Tampa a couple of weeks ago, and we're having them back to find out if what they were planning to do worked, if they were able to collect their rents in a timely manner, and if there was any difference. And a lot of our members are wondering if there's deals to be found in this market, and so we'll be giving updates on that tomorrow as well. Okay, next slide. And this is the disclaimer. We're going to maybe be giving some opinions. Shawn will be talking about different loans. Now, not everyone's going to qualify for those, so this will be different for everybody. Always speak to your accountant before doing any investment in anything to see how it might affect you. And if you're signing any agreements, you might want to have an attorney look through those too. All right, that is the disclaimer. And Shawn, tell us about yourself. You've been with Chemical Bank, and that's changing now, sort of?
That is correct. We've merged with TCF, and that's officially as of last December. So the name change will actually take place in August is the time frame.
Okay. And you've been lending for 26 years, so you've seen a cycle or two. Ranked number 13 in the country for total units closed. That's amazing. I hope we were instrumental in helping you win that award.
You guys are also big into that number, so.
Awesome. In 2020, you'll surpass $2 billion in personal mortgage lending. Wow. So thank you for being here to give us a little more insight on what's going on.
Thank you very much. So thank you very much for having me today and allowing me the opportunity to present to you, RealWealth Network Group. Pretty much what I just want to share with you what's going on with COVID-19 and how it's impacting the mortgage world. Obviously, this is changing every day. Basically, this pretty much goes back to the end of February when we went through the mortgage crisis. Then we jump into the rates hit an all-time low for 2 or 3 days. Pretty much what happened with the coronavirus when that hit, the factors of the mortgage industry are not moving like they normally would move. So basically, we hit uncharted territories. We saw rates hit an all-time low for 2 or 3 days. To put it in perspective, 2019, the mortgage industry probably did $2.5 trillion in mortgages as an industry, and then within a 30-day period, over $2 trillion was locked in to refinance purchase transactions when the rates hit that low. So when that occurred, basically everything just went crazy. So the volatility went through the roof. Industry resources were tapped, meaning title companies, appraisers were tapped. So basically that created a little bit of delay in the process. Mortgage lenders reached capacity and went beyond capacity. So what that means is it's not really business as usual. When they went to capacity, we're seeing some of the banks completely shut down, like refinance lending, completely shut down non-jumbo products, just kind of make quick changes to slow production down so as a bank that they could keep up. So pretty much a lot of the stuff that's contributing right now, again, with the rates hit, we're seeing the projection at the beginning of the year was to do another 2.5–3 trillion in business. After last month, the projection jumped all the way up to like 6.5 to 7 billion was the
Wow.
projected, which is the question mark. So obviously we can see what's going on with the industry. So what happened is usually the mortgage rates follow the 10-year Treasury. So the 10-year Treasury we've seen this jump as low as 0.6, and it's dropped below 0.6 for a little bit, then came back. Normally that would mean you'd probably have 30-year fixed rates under 3%. But again, the market's not following that. So we can't predict the market. So what's happening is we're seeing rate changes 3 or 4 times in a day. And we're learning day by day how that happens. For instance, the agencies, when I say agencies, Fannie Mae and Freddie Mac, they'll hit their limit and adjust the price because they're at capacity also. And basically then you have lenders at capacity. So again, it's just a very volatile time. So when we're talking to investors, purchasers, my suggestion and recommendations are always, if you like something, what you see, jump on it. And I just tell them there's a fine line between being good and being greedy. If your ROI is there, take advantage of it because, again, we've seen rates adjust by more than 1.5 points in one day. So it's been doing this 26 years, the most volatile I've ever seen it. So as we go through this, then now we're in the coronavirus, we are seeing some temporary relief for customers. When I say relief to customers, the appraisal process has changed a little bit. Obviously, with the safety and keeping everybody safe, away from each other, social distancing, we're seeing a relief on appraisals. So sometimes the appraisers, we can get exceptions where the appraiser does not have to go into the property and put anybody at risk. So, and these are Fannie Mae, Freddie Mac guidelines. On the other side of that, we're seeing people that they're losing their jobs or going on furlough at the last minute, and at the closing table, we're finding out that maybe they were laid off last week or they were furloughed, which basically now we have to use different income. So we're being proactive up front now and letting customers know to let us know as soon as possible if something changes, because we are going to find out. So they're doing verifications of employments like 3 or 4 days prior to closing. Then now they're doing it at closing too. So we had a couple situations where at closing, they found out the day before they were furloughed, and some people think that, well, I have a lot of assets. It doesn't matter. Well, at the end of the day, we do still have to follow Fannie Mae and Freddie Mac guidelines. So with all of these industry resources being strapped, servicing values declining, which basically is going to hurt a lot of banks, and we'll talk about that as we get into the Forbearance and the CARES Act. We're seeing a lot of the non-banks being challenged. So basically, they're pulling back their guidelines on like FHA, which really not impact investors, but we're seeing people just flat out get out of doing jumbo lending, basically, and that's because of the servicing values being so low. The non-banks are pretty much the middleman between a bank and a broker, another bank. So they don't pretty much know, well, the bank knows who they're going to send. The investor probably doesn't know where their payment's going to be shifted to. That's the big difference with TCF, is pretty much we just merged with Chemical Bank, so we're a $45 billion operation. We're very liquid at this time. So we have not seen any adjustments to products that will affect investors. We have basically put a timeout on our construction lending. That's it. And the only reason for that is there's too many people involved in a construction loan, and we're seeing suppliers shut down. So again, that's also a little bit different from that respect. Kathy, your picture jumped out. I don't know if that was you. There you are. So basically
Okay.
I'm sorry?
Did you want to go to the next slide, or are we still on this one?
Nope, we'll go to the next one. So this is a little bit what we shared already. Basically, these are the impacts on mortgage. We have appraisal concerns. When you're getting a mortgage, basically 4506Ts, we have to verify tax returns provided to the lender, match what's on the IRS. Obviously, with the COVID ID, basically those are being delayed and not running anymore. So we got exceptions that we can close without that form in there. Then we got temporary guidance on appraisal process, income process. Again, I think we already touched on the major effects of the non-bank lenders. Then really the non-bank lenders too, biggest factor that we're seeing as affecting people is they're just basically saying, we stop doing this, any applications in process, go somewhere else. So it's very important that you make sure that who you're dealing with up front to make sure that they're going to get you from here to the finish line without any hiccups. And again, it's unprecedented times, so anything can happen in the market that we're in. With the mortgage lending, with the COVID-19, we are seeing the federal government jump in and provide a lot of different assistance to different people. So basically, you have the CARES Act for personal and business. Basically, you have if you have a mortgage, you can contact your mortgage lender and do the hardship assistance program. Basically, what that means is you can request a forbearance. So if you have a hardship due to the COVID-19, you can reach out to your service provider, so pretty much who you're making your mortgage payment to, and ask for a forbearance on your mortgage payment. So they can tend to be 1 to 12 months. So typically, the first 90 days is not going to affect your credit. And technically, month 1 through 12 should not affect your credit as well, assuming you've been through the proper means to get the forbearance through the bank you're lending through. So again, it's still a work in progress. My guess is each lender's handling it slightly different. So pretty much like if you go beyond the first 30 days, you've got like 3 different options. Usually you can pay it back all in one lump sum, which is probably not going to be the case. You can set up a payment plan where basically, depending on what you qualify for, they can add a payment plan, like a 12-month payment plan where you can pay it back. Or the next step would be just going to a modification. So if you go into what's called a modification, pretty much what they're meaning is they're going to send you docs to add that principal balance to the loan and extend your maturity date probably another 3 months. So as you can imagine, if lenders start getting into the modification piece, that's a lot of paperwork, a lot of individuals involved, and a lot of contacts with that respect. So one of the things that I did learn of recent is in July, Fannie Mae is going to come out with what's called a deferment. So pretty much it's similar to forbearance, but they're going to defer the mortgage. And what that means is they won't do a modification. They're just going to add a lump sum, a balloon payment to maturity. So whenever you request a payoff, or when you get to maturity, you'll have a balloon payment to offset any payments that you had to suspend during this COVID situation. With the COVID-19 Chemical Bank TCF plan is pretty much, depending on your hardship, you can make a half payment or you can make a 100% forbearance, but the chemical bank is going to ask the borrowers to continue to pay taxes and insurance, because obviously we want to keep the house insured and we want to keep the taxes paid at the minimum. As far as do you have any questions on that, Kathy? Because I know it's kind of like all over the board and it's throwing an arrow at the board.
All right. Last week we had 3 lenders on who are they're their own servicers and different than what you do. So what they said may not be the same as what you say, and that's why it's just important to understand every lender is different. But for the people that got loans with you, they can potentially do the forbearance, and they'll have to pay that amount later, right? So
Correct.
they're not off the hook. Would they have to, if they took 3 months off or whatever, 3 months forbearance, would they have to pay that lump sum in 3 months?
With chemical, they'll have options. They'll have basically, they can pay it back all at lump sum. We can create a payment plan, then we can do a modification. So if we go into months 4 through 12, then more likely it's going to be a modification. The wild card is, what does that do to your credit? So
yes.
If you go through the right steps and you're dealing with the lender, they are going to mark it as a forbearance, which basically means it's delaying any credit impact. The question mark today is, how does that affect you moving forward? Meaning, in today's market, if you had a forbearance or a modification, it would pretty much put you in timeout for 2 years. I'm learning that's probably not going to be the case because it's a natural disaster. So there's a way that the lenders are going to be able to tag this as a natural disaster, in my opinion, and it's not going to affect the people moving forward. But obviously, you probably don't want to go into a forbearance and be in the middle of purchasing a loan right now today, because again, mortgage lending, we do have, I mean, you are being qualified with reserves for special situations, but you definitely want to take advantage of the forbearance situation if they create a hardship with your financial situation and your family.
Yeah, that was a question that came up last week, as somebody said that their broker told them they could do the forbearance now, not going to affect the credit, but they're planning on buying a new home in about 6 months. And would there be an impact? And I thought, boy, if you want that new home, I probably wouldn't do the forbearance, because basically you're saying you're having financial hardship, but then still trying to buy a property, right?
Correct. Yeah, in 6 months, I mean, at the end of the day, your situation could change. So if you have to take advantage of the times today to get you through, I mean, hopefully within the next 2 to 3 months, we're out of this situation, you're back to work, and you're basically getting your feet back on the ground. So if somebody needed to do a forbearance today, I mean, they realistically could probably buy a house in 6 months if their situation went back to as normal as you can get in today's market.
Wow. Okay. That's a different message. That's amazing. Okay. Again, every lender's different. And the difference being
again,
that what was that?
Well, we're learning every day too. So it basically, some of this stuff is just coming out and it's not finalized. Actually, I have family members that are senior underwriters for a group out of California, and she's in meetings every day trying to learn what's changing today. So again, what we have today was probably a little bit different than what we had last week.
Yes. Okay. All right. Federal CARES Act. I don't know how much you want to go over this. We know there's some issues there right now.
Well, right now, actually, we just got a message today that the federal government has reached their $350 billion. So there's a lot of people with applications out there today. So this is really for the small business and different programs, like the EIDL is more for like a $10,000 grant. So maybe if some investors have LLCs, properties in the LLCs, they're probably looking for that program. But again, as of today, we just heard that they reached their minimum, the $350 billion. So now they're waiting to see if the government's going to come back out with another bailout of the $250 billion, which they believe is the impact on that. So again, one of those situations where you got to take care of your workers, your family. These are the programs set aside to help that situation during these times.
Yeah, I don't know when we'll know about that next round. And I heard it might not have the same terms as the first round. So, well, again, time will tell. Now, were you a broker for those? Were you helping people get those loans?
Yes.
Okay.
Yes, actually, TCF they've taken a lot of applications. I think over 15,000 applications is the last number I saw.
Okay. Woo. All right. Well, let's keep going through this. So current guidelines, how much have they changed, and what's it take to get a loan, especially for investors, but also for first-time home buyers or for home buyers?
Okay, so we do a lot of your investors, so we deal with the RealWealth network, but we also do primary mortgage lending. So pretty much we follow the Fannie Mae, Freddie Mac guidelines, where the non-banks, they do have their different programs, and that's where they're coming down and changing them, such as the non-QM deals, the jumbo pricing. Again, in chemical bank TCF world, our guidelines really haven't changed. We're following the Fannie Mae, Freddie Mac guidelines. The only questions we get a lot from customers are, can we avoid appraisal? Can you do a drive-by? Do they have to come in? Every situation is slightly different. So especially when we're dealing with investors doing refinancing, basically, if you're doing a cash out refinance, the guidelines, you have to have an interior inspection when you do a cash out refinance on investment property and on a primary. So we're just letting people know, make sure your tenants are aware, make sure you can get in prior to starting this, because we don't want to take your application fee and pretty much have a half appraisal done and not be able to finish it. So those are the slight changes. If it's a rate term refinance, Fannie Mae's got their guidelines, Freddie Mac's got their guidelines. So a lot of times we can get a drive-by or an exterior only appraisal in. So Fannie has provided a lot of relief to kind of avoid having contact with tenants. I have a lot of appraiser friends, and they're stating if they the appraisers don't want to go in themselves. So, but if they do have to go in, they've got their protocol, their slippers, their sanitizer, their gloves on, and they're being as safe as possible to get through that situation.
So on this, it shows for
So,
purchase. What would be a typical? I mean, are there still low down payment options for principal residence?
principal, yeah, you can do as little as 3% down on principal
Okay.
residences.
Great.
On the investment property side, we've seen the mortgage insurance companies, because you could do as little as 15% down on a single family investment, but they put that on hold. So the minimum down payment for a single family investor would be 20% due to the MI mortgage insurance restrictions. But owner occupied, we have programs as little as 3%. FHA, you can do as little as 3.5%. That's one of the things that the industry's done, is raise the credit scores on the FHA, the first home time buyer programs. Used to be able to go down to 580. Now they've minimized them to 660.
So you have to have better credit across the board, even for
Correct.
your primary. Mm-hmm. What were you seeing?
Actually, the primary is the same thing.
The primary is what?
The primary hasn't been affected as of yet, unless certain banks are doing their own overlays on the industry guidelines.
Wow. Oh my gosh. So, I mean, it would still make a lot of sense if you're a first-time buyer to get an FHA loan and maybe try to get a fourplex, rent the other 3 units out. What's the limit for FHA loans on a fourplex?
Depends on where you're at.
It does depend on where you're at, but let's say Florida.
I'm not 100% sure. We don't do a lot of them, but I'm sure it gets up into the million, 800, 900 to a million price point. I'd have to research it for you, because it's different per state, per county. And like, for instance, in your area, it's basically still, because you're considered high conforming limits, your limits are going to be a little bit higher in California.
Yeah. So, I mean, this is still probably the best opportunity out there is the FHA loan. Very, very low payment down.
Yeah, I mean, in my opinion, the rates are still at all-time low. That's what we got to keep in mind. That the industry rates are pretty much in the low 3s. So home ownership is huge. Return on investment for investment properties is still big. And you can address this more, but as I'm working with the investors, we're seeing that there's more investors out there than of inventory. So I'm sure you can speak to that more. So as I talk to different investors, my encouragement is make sure you have your ducks in a row, because there's more than one person in line for a specific property.
Yeah, and we're getting access to some inventory we couldn't get just over the last few years. It was so tight. We're getting properties that would get bought so quickly by big hedge funds or by home buyers. So I wonder, and you tell me as a lender, if somebody is working at home now and they hadn't before, but they are now, and it looks like that could be the case, and they live in California, but they want to buy that fourplex in Florida, could they do that? As long as their lender says that they would still be able to work.
Can they do it as an owner-occupied property?
As an owner-occupied, yeah. If they're going to move there.
It just has to make sense. So pretty much in that situation, you'd have to get a letter from their employer stating that pretty much they can work from Florida. They can work remotely, and that's going to continue to be the place. If you're working for a company in California trying to buy a place in Florida, basically it has to make sense. So if they're just saying, no, once we get through out of the stay at home, basically they have to report back to the property in California, then it doesn't make sense. So they would not be able to do that as an owner-occupied.
But if companies start to figure out that working from home works, then that might give more options to people acquiring property who just couldn't do it in California, but now can live somewhere else, work from home. Okay, and still up to 10 loans on the investor side?
Yes, basically you can still, and again, this is another one of the non-banks versus the bank situation, is we still are following industry guides. So each one person can have a total of 10 finance properties. The misconception out there is you can do 20% down on all 10 properties if you wanted, where 2 or 3 years ago, the characteristics changed after 5, but you can do 20% down for all 10. The only thing that changes is once you get to property 7 through 10, you must have a 720 plus credit score. then the reserves keep increasing for each property that you acquire.
Okay, good to know. All right, Fannie Mae temporary guidance, anything new on here?
No, these are some of the things we already discussed. Basically, just making sure the free people are still working. If somebody gets reduced income during the loan process, we'll try to qualify them on the reduced loan. So we can still qualify people even if their income's reduced. They just still have to apply, qualify debt to income wise from that regard. So that's just more information that if people start asking about income, about appraisals, these are just kind of temporary Fannie Mae guidelines that we can share with anybody that needs them.
Okay.
And these are the appraisal processes that we've already discussed. And pretty much we've added some slides that basically if you want people to share about how forbearance works according to a deferment, we've kind of stepped on that as well.
Yeah, I just took a screenshot of these from the Experian website, kind of explaining in a normal world, forbearance would absolutely affect your credit. If you did that, it would be considered a delinquency. But if you go to the next page, it's just different if in this environment, like you said, it's a national emergency. So if you go to these websites, Experian's website, it will kind of explain what could happen. Again, nobody knows exactly. It all depends on what the lender's willing to do. But it says here, the bottom line, loan forbearance can be a helpful tactic for protecting your credit when you cannot make your monthly payments, because forbearance is a built-in option for many student loans. So that's good to know. Yeah, so do check this out if you're, let's see. Now this slide came from Myers Research. They did an update yesterday, an economic update, and here's kind of some of the best and worst case scenarios that could happen if more people do forbearances. It could cost, you could see sort of best case over on the right, the cost for 3 months versus the cost for 6, and then worst case, cost for 3 months, cost for 6 months. So if you go to the next slide, these servicers don't, they're concerned. So many of them have come together and sent a letter saying we need $100 billion bailout. What do you think are the chances of that happening?
It seems like they're bailing out everything else, but again,
Right.
mortgage lending is essential. But what people need to realize is even when you go through the forbearance, although you're not making a payment, the lender has to be making a payment to the agencies, which might be Fannie Mae or Freddie Mac or the investor on the behind the scenes. So this is what we're going to see: challenge and liquidity of many of the banks. So I think as we depend on how long this continues, we'll see more and more banks continue the struggles. We've seen some of the bigger banks already pull back in different ways, pull back their production, increase their standards, and a lot of it is just pretty much trying to control the volume coming through the door.
Really? Okay. All right. So yeah, my guess is there'll be a bailout. The government wants to keep the housing market afloat, right? It's good for the economy. So
Most definitely.
Yeah, that's why we see so much money going with the Fed buying mortgage-backed security, buying mortgage-backed securities and bonds, trying to keep those interest rates low. It's very important to keep the housing market propped up. All right, so
pretty much, in my opinion, I mean, I think after this, the housing market's going to continue to be strong. They're predicting rates to continue to be low. The federal government is stepping in and spending billions on purchasing mortgage-backed securities. So again, people might think that they're buying mortgage-backed securities to lower rates. I think they're just trying to stabilize rates. So that when they purchase the mortgage-backed, it's not to lower the interest rate. So again, this is where you have that conversation with the borrower, fine line between good and greedy, because we're seeing maybe good rates open at 10 a.m. and by noon they've already adjusted once or twice.
Well, they're really just trying to keep the money flowing, right? Buying those so that you can keep lending. Yeah.
Correct.
Otherwise, it would just come to a screeching halt. Yeah. So I haven't gone to questions yet, but I do have this question. I know you can't possibly know the answer to this, but I just want your opinion, and it's your opinion only. As somebody with an inside look into the banking system, it seems like banks learned a lot from 2008, 2009, and realized if they put a bunch of distressed properties on the market, it hurts them, right? It hurts the assets that they hold. And so it seems like towards the end of the mortgage meltdown, banks were doing more for modifications, more kind of working with people, even just letting them stay in houses and not pay, you know, so as not to put it on the market. Then we started to see some banks, instead of putting a distressed property on the market, they were hiring construction teams and fixing them up so they weren't so distressed, to keep the values up. I met a bunch of contractors that were hired to do that. And then even seems like some were even going into the rental business, holding them, renting them, realizing again that would be better for asset values. So do you think, I mean, I think a lot of investors are wondering if they're going to see another, you know, foreclosure situation where values will come down and there'll be foreclosures everywhere. My gut says the banking system won't allow for it, but what are your thoughts?
I have to agree with you. I mean, they've been there in 2008. This is a slightly different time than 2008. So I don't, 2008 was where properties were just depreciating, and the only way that people get financing were the HARP programs where you can get up to 125% financing. The banks do not want real estate, so they do not want the properties back. So I think the housing industry is going to do what it takes to keep people in their homes, to allow them to pay mortgages. Case in point, the Forbearance, the CARES Act. I mean, they're stepping up with ungodly dollars to keep people in their homes, keep people paying their mortgages. And again, lenders don't want them back. You do hear about the big banks that are buying groups of properties. They're not the normal big banks that are doing that. But again, they're going to do what it takes to keep people in their homes making the mortgage payments, is my opinion.
That's kind of my opinion too. At least it seems to be playing out. Okay.